I'm Scott Bauer, CEO of Prosper Trading Academy. In addition to learning those correct habits to trade over time, there are also 3 deadly sins that you must be aware of. Traders always talk about their winning trades, those trades that just blew up and they hit a home run. But rarely do you ever hear of those bad trades. But successful traders, they learn from those trades that didn't work. They learn what may have happened, why the strategy didn't work, and they take that and improve themselves moving forward. So over my years of trading, I've really kind of discovered the 3 deadly sins of options trading. Trading options, just like trading any other type of financial instrument, involves a number of potential pitfalls that can quickly drain your account. Knowing some of these possible traps that traders commonly fall into and how to avoid them can give you an edge in your trading and potentially give you more staying power in the markets. Through my over 30 years of trading experience, again, I've identified 3 deadly sins of option trading and ways to keep your trading free from evil. Sin number 1, buying options and letting them expire worthless. This one's really a no-brainer. When you purchase an option, whether it's to hedge, play a market direction, or get long volatility, you should still draw a line in the sand. Just because your risk is limited on an options purchase to the premium paid does not mean you have to sacrifice that entire premium. Many novice option traders make this simple yet significant mistake. And because of the defined risk nature of long options, they consider it to be a set and forget type of trade and willingly lose all the money they paid for the option in many cases. Let's look at a quick example. Investor Joe believes the price of stock ABC is about to go up. ABC is currently trading at, let's say, $50 a share. So Joe does not want to buy the stock and decides to purchase a front month at the money 50 strike call option for a premium of $3.50 or $350. Joe makes his purchase, watches as the days go by while ABC just kind of trades sideways right around the $50 level. Joe's option had 4 weeks until expiration. 2 weeks after his purchase, with no real bullish market movement to speak of, Joe's $50 call has lost half its value and is now only worth $1.75 or $175. Obviously, Joe's market forecast was incorrect. He could take his loss at this point, move on to the next trade, or he can continue to hold the call option. Many novice option traders will hold the call until its value declines to 0. Don't be that trader. Decide how much room you're willing to give the trade and then stick to it. A simple rule of thumb is to cut losses once a long option has lost 50% of its value. Sin number 2, buying deep out of the money options. Let's make this one easy to understand. Trades are trades, and lottery tickets are lottery tickets. Many novice option traders believe they can possibly turn a profit by purchasing very cheap, deep, out-of-the-money options. Do people win the lottery? Of course they do. Have you or I ever won it? Probably not. And to be clear, out-of-the-money options may be very useful for trading directional moves or for volatility plays. You want to make sure, however, that the options are not so far out of the money as to make the probability of that trade working almost non-existent. While deep out-of-the-money options may represent less monetary risk due to their smaller premiums, these options also have a statistically significant low winning percentage. The underlying instrument would, oftentimes, have to make extremely substantial moves in price for these options to pay off, not to mention the fact that the power of time decay is always working against you as well. If you're going to trade, look for trades that have an edge to them. Look for positions that can potentially profit without an absurd move in the market. That $100 you might have spent on an S&P call that's 200 handles out of the money, well, that can buy a lot of lottery tickets. Sin number 3, selling options when implied volatility is low. While option selling has the potential to provide an income stream, it also has the potential to drain your account with large losses, especially if you're selling naked options with unlimited market exposure. Many new option traders get this one wrong also. Options consist of many moving parts, and while market direction and time are important, implied volatility is a huge component of option values and pricing. Many professional option traders trade option volatility and nothing else. Just as with a stock, you want to buy low and sell high, or sell high and buy low, the same goes for options. When selling premium, you want to sell high implied volatility and buy low implied volatility. And many traders get caught in the trap of selling options that are currently low in implied volatility only to watch the option's value explode as volatility increases. Implied volatility has a tendency to revert to the mean, so only look for opportunities to sell options when that volatility is on the high side. Conversely, if you're going to buy an option, you'll want to look for options that are currently on the low side for implied volatility. Thank you so much for watching. If you liked what you saw, please like, comment, or subscribe for more content.